We filed Jazz and Warren.
So last time I saw it, it was on my desk. Megan asked me where it was, and I told her it was here. I don't know if she took it somewhere though.
The actual property.
Just keep losing that one. Not that one with bars too. You know what? I can live Okay, cool. No, I'll know what you right now. Awesome. Yeah, Hawaii. You like it? Yeah. All day. What?
it. It's not to have red wine and seafood.
Yeah.
I mean, seafood,
I'm gonna
so
do it tomorrow and
Kind of
Friday.
bummed about the rest of the red wine.
Think about it.
Yeah, everything you want.
Yeah.
Two burgers.
Well, stay around this area. I would say that Deer Park Drive around there. Yeah, I would say around here.
Yeah.
You feel like it's on.
Oh, no, it's almost. I don't know, I'm too young to care about this right now, but I'm sure I'll, slowly changing my mind.
Very little. I do know one of the veterans, been converted to a gorgeous, walking closet.
All I heard from her, she walked in, was, oh, I should know by Monday something.
Yeah, she was a general student. But, you know, so it's also. Yeah, definitely,
How long is this class normally?
Maybe.
Yeah.
This is one of the shortest. So. Last time I had to do this, I ended up in class. Not supposed to curse on people. Especially on my. It's my first PBA telecast that I made back in 2002. And I wasn't bowling very good during that night. And the one good ball I threw, I left a solid landing. Not real loud, but just. That made it on the ESPN. Haven't seen any of the YouTube stuff yet. So the meeting actually ran quicker than I thought. The great stuff with me, I always get to on Zoom. Let's see if it works this time. This is another one for LA or Compton on the screen. Ah. Actually, it looks plausible. Yeah, this one just came in long range. I actually called two of them today, the two that I couldn't get on my phone.
Yeah.
Both viable, Spanish speakers, but viable.
I heard you put the Spanish. on the watch. That's what, you're able to do that. Got it.
Are we recording it?
It looks like I got both recording and recording to cloud right now. Yeah, it says
Yes.
recording to cloud right there.
Okay, perfect. Well, then we'll get underway. If anybody comes in on time, I shouldn't say late. Rewatch. So welcome. The purpose of this class is to teach you what you as an agent need to know about lending. It's going to make both a lot of the things that are in-house lenders say make a little more sense, or any other lender that you may use, as well as the biggest purpose is to allow you to function without a lender attached to your hip. Because we should be doing that 99.9% of the time. So first, we need to look at the big picture. What is underwriting? Simply exercising the 3 C's of credit that you likely learned in pre-licensing to determine if a buyer or borrower is worthy of extending credit. Well, we're not underwriters. Some basic questions will be able to help us decide whether or not to proceed with a buyer, whether it's writing an offer at an open house, or even if they're a viable buyer today. You know, just because they're not a viable buyer today doesn't mean they won't be 3, 6, 9 months from now. You know, depending on what they need to do, they might need to save more money for fixed credit. Better jobs, something like that. My lender, we've got buyers lined up 3, 6, 9 months down the line that are usually in some form of credit repair, and they need to bump FICO somewhere. There's lots of different ways to do that. So to understand the process, when an underwriter receives a loan package, and this is after your loan contact gathers everything, application, verification of income, proof of funds, etc., then the process of evaluating the risk will begin. And this is usually a single individual. I was an underwriter for many years for Bank of America, done thousands of loans. And what we look at as an underwriter is loan to value ratio, and that's probably the biggest thing that an underwriter looks at, because an underwriter is looking for ways not to do the deal, bottom line. So different programs require different loan to value ratios. Loan to value ratio is simply your loan amount divided by the purchase price. Lenders lend on loan to value, not purchase price. Loan amounts, and the reason why loan amount is there is different programs have different caps, and you'll hear the word conforming loan. Well, that is under a certain amount. FHA, for example, an FHA conforming loan will not ever go over a certain amount, and that varies based on the county. Conventional will, but then it's called a jumbo or a non-conforming, depending on the actual amount. And down payment, of course, debt to income ratios, those vary based on program. Length of employment, length and quality of credit history, also residence requirements, and of course appraisal. So when we're qualifying a buyer, whether it's us or an underwriter, employment, residency, and income requirements are looking for a 2-year continuous history. Now, people do jump from job to job on occasion, especially in the medical field. Nurses and caregivers, LVNs, things like that. I've sold many that have had 4 jobs at one time. Okay, and they might move a couple of those around. It's helpful for the underwriter, but it's okay. Or even, one time I had a guy who had worked at a motel in San Luis Obispo or somewhere for like 15 years. And then he comes to me and he's a chemical engineer, not exactly the same field. But it worked because the underwriter just asked for a copy of his degree that showed he was qualified to do it. And since while he was working there, he was in school, got his degree, left the motel, became a chemical engineer with a big pay raise. So as long as it makes sense, it will usually work. Credit history. They will run what they call a TriStar. That's all three bureaus, Experian, TransUnion, and Equifax. You will have a different credit score with each one because there's going to be some differences in the report. There are some lenders that will only report to one or maybe two of these. On occasion, especially if someone's young or just not a big user of credit, you might only have one or maybe two credit scores. That's a different challenge and a little bit beyond the scope of this class, but there's still ways to handle that. And also the majority of your FICO score, a lot of people don't know this, is your payment history within the last 2 years. Okay. You did have bankruptcy 5 years ago and still have 700 credits. I see that all the time. Another big portion of your credit score is the amount of debt, the amount of your capacity of debt that you're using. Let's say you have $10,000 in credit limit on your credit cards, but you only owe 2,000. That's great because you really want to keep that under 30%. Anything over that's going to start taking away your FICO score.
So only use less than 30% for
Yes.
your max?
Mhm. Yeah, keep under there and you won't get under FICO. It's hard sometimes. Especially in this business where budgeting is so crucial, because we get paid in fits and starts usually, especially as we start. And, but even maybe, I mean, I blanked in, was it March? I think I had no closing for March. I only had one, I think in April and May. I mean, it happens. Yeah, last year I closed 48. I do say in
January.
January. So it does happen. So managing your money is crucial. Sometimes, especially when you're starting, you bounce stuff off of credit cards and maybe, knowing you're going to get paid 30, 45 days later. So there's sometimes you can't avoid it. But, oh, and by the way, credit score is 470. Yeah, there's so much. We did one. So 3 basic programs that you'll deal with. My personal favorite, FHA. I've made a very good living on FHA buyers. This is going to be the majority of what you see. Now, FHA has a base credit score of 580. Now, on occasion, you'll find a lender like mine that has investors that will go down to 500. Pricey loans, 10% down, but it can be done. One thing you have to understand about loans, everybody can get a loan. Okay. They just may not be happy with how much they have to pay. So 580 is going to be a pricey FHA. Probably going to sit around 7. So before today's fiasco, probably going to sit around 7, 7.5. Would rather than be at 620. That's going to be your typical FHA better pricing. And just remember, if they're 580 or less, they have to get 10% down. Minimum down payment on FHA, and one of the things that makes it so attractive is only 3.5%. Used to be 3 many years ago. There are some additional programs that we're not going over. Down payment assistance programs that are out there that are typically CalHAPA that will pay some of that 3.5% and the closing costs. So even if you have a cash forward buyer, which bad credit, no money, no those might be there are options out there for them. Those typically have median income requirements, so it's not going to get you a whole lot. And the way things are in Orange County, probably not going to happen in Orange County, but San Bernardino, Riverside, still very, very viable. Conventional has a minimum FICO of 620 for most of their programs. Now, they do offer a 97% financing option that was originally offered as an alternative to FHA after the crash. A lot of HOAs were not renewing their FHA certification. So to try to help first-time buyers, or which are usually condo buyers, they came up with this 3% unconventional. Problem is the minimum FICO is 720. And they're pretty pricey, so they're very hard to get. It wasn't much of a help. Then you have VA, also a government loan, also a 580 minimum FICO. The qualification mirror FHA. And would you do me a favor? Would you print the packet I have on my computer for Sean? So roughly the same ratios. They have a function residual income analysis. We'll kind of go into a little bit later. And then you have hard money, what we call non-QA. FICOs don't matter much. Gotta have one. But pricing is going to be very much based on that. These are usually done private through private investors or through some mortgage bankers like Accelerate. Credit criteria is going to be all over the map, but the biggest thing is going to be LTV. They usually want 20 to 30% down. And you're talking about now probably 12% interest only. Short term, 3 to 5 years. And again, while it sounds horrible, if that's your only option and you gotta move and you can afford to make the payment, it's there. I did one, it's been about 2 years now. I sold this lady's condo in Covina. She had no job. She sold CBD pills or something. And she needed to get out of there. And we sold, she had equity, she'd been there a long time. And she went, I think, 40% down on the nice pad in Cathedral City. 9.9% interest only. While she fixed her credit, got a job, and we refied her into an FHA because she didn't break. There was no way she would raise much more than 680. We had to get her over 620 because she had like a 40. So again, we cut her payment in half and got her where she needed to be. She made that 9.9% interest only for about 9 months. She did it real quick. And ultimately, the 9.9% it was still a little bit more expensive than the 3.5% FHA that she got. Yeah, but if it was 9.9% fully indexed, principal and interest, her new loan would have been at least half or less than what her payment would have been fully indexed. So when we talk debt ratio, debt ratios are simple. You have two debt ratios. You have your front end and you have your back. Okay. Your front end ratio is simply your monthly housing payment, your future monthly housing payment, divided by your monthly gross income. Your back end is your housing payment plus all the bills that show up on a credit report. Okay, this isn't your cell phone bill, your utility bill, something like that. But it could be student loans, it could be other things. Again, divided by your monthly gross income. We use gross income, not net. Yes.
Question, so for net, we have the rent, but some of the buyers right now, they're paying rent, we have the monthly rent.
So we'll get into that a little bit later. Whenever you're getting into self-employment and a lot of rentals, unless you're really experienced and see tax returns, I'm going to recommend that you don't even bother with it. But I'll show you a little bit how to get into it. Because they're simply the rental income has to be seasoned. They have to have done that at least 2 years. So that there are some programs that are one that usually it's two. Because it just depends on what you're talking about, who you're talking about. So FHA will go no higher on the front end. That's your monthly housing divided by your gross income no higher than 47. Back end, real loosey goosey. I've actually gotten them done at 59%. So another great thing about it. Conventional, 38-ish. There's not a hard cap there, but right around 38 is where they're going to tap out. The 45 back end hard cap, you can't do without an underwriting exception, which means the lender's gonna keep and service the loan portfolio. So we remember from pre-licensing, we have the primary market and the secondary market, right? Your secondary market's Fannie Freddie. If you do this, Fannie Freddie won't buy it. So let's say Bank of America is doing the loan, they do an underwriting exception. That means BofA is keeping it and servicing it and never selling it to Fannie Freddie. The big banks will do this, the little ones won't, if they make money off selling the loan. VA doesn't care. VA does this residual income calculation that I honestly don't even know. But the basic gist of it is if you can afford to eat after you pay your bills, you're good. Okay. I've done VAs as high as a 70% back in debt ratio. So because it qualified under their residual income analysis. And hard money usually doesn't care about debt ratios. Because again, as long as they're protected loan to value wise, they'll just come take the house. Okay. Net sheet. So in your packet today is a sample net sheet on a form that I created about 20 odd years ago on Excel. Some of you I've sent it to. Anybody else that wants it, let me know. I'm happy to share it. Everybody, every real estate agent, in my humble opinion, should be able to write out a net sheet on a cocktail net. Written in on a cocktail net. However, this sheet does all the work for it. So your typical closing costs on 98% of loans that deals that you're ever going to do is your loan origination fee, points. Additional loan fees or garbage fees, as we call them. We call them, lenders will call them underwriting fees, processing fees, you know, ticket processors a lunch fee. I mean, there's a lot of them, which is why we call them garbage fees. Your appraisal fee, small fee for a credit report, tax lien service, title, escrow, sub-escrow, loan tie-in fee, just call them for miscellaneous, prepaid interest, insurance, and mortgage insurance. So going into it one by one, I started to, I remember that I had a slide through, Joe. So a loan origination fee is a percentage of the loan amount, not the purchase price. As agents, we deal primarily with purchase price. When we're talking about loans, you got to kind of switch hats. Now you can buy down your interest rate by paying more in points. So for every interest rate, there is a cost. If you hear a lender saying, okay, today rates are at 6% at a half point cost, that means you're paying 0.5% of the loan amount to get that rate. Now you might be able to pay a point or a point and a half to get a slightly lower rate. So, but it's not equal. You know, the further you buy down, the more it costs you for less of a drop in rate. So there comes a point in time where it doesn't make sense. Personally, I like to deal in no point loans. Lenders don't like to do that right. They haven't for about a year and a half. It'll come back around. But typically, the average lifespan of a loan is 2 years. So if you're buying down your rate, the difference in your monthly payment, you're not going to make up in 2 years, even 3 years. So it doesn't make sense to do it. You're just throwing money away. Now, it can also flip and go up. So let's say today's rate is 7.25 at par. Par means no points. Okay. But my client's cash flow. these guys down payment, they really doesn't have much, if anything, for closing costs. Well, guess what? Not all lenders will do this, but let's say, okay, let's bump them to 7.5. That's gonna create a rebate for the lender and mortgage broker. Okay, mine in particular will take that rebate, credit it to the buyer. If it's possible. Especially good tool on deal.
You say they pay the percent or like the half point, is that coming from the deposit that is down? Down payment?
Not
How do they? keep it?
particular, it's coming from the buyer's pocket somehow.
Or when
Okay,
do they keep it?
at closing. Yeah,
At the
the,
closing cost?
right, exactly, it just gets added on onto the closing house. Great question. Because the actual earnest money deposit just sits there as a show of good faith, and in case the buyer cancels without a good reason, then it's all right to keep that. But that is also part of your down payment as closing house. Any questions on this? Because I know sometimes this is a kind of a different concept for people because it's not what we normally think of. But the lenders make decent money, not as much as we do, but they make decent money. And they can create rebates both out of their pocket or by adjusting the interest rate. And different lenders that they may be sending them to, that they may be correspondents for, will sometimes pay them a bonus for certain types of loans, certain loan programs. So they can also create a rebate for that. Usually the rebate's not big enough to pay every penny of the buyer's closing cost, but it usually make a very big difference. Appraisal. The appraisal is going to vary based on the scope of the appraisal, the size of the property, and whether a rental survey is required if you're buying it as an investment property. I calculate $550 for just your typical single family or condo purchase. These days, you know, that's going right. They're starting to inch up a little bit. So if you wanted to figure 600, you're good. But some larger properties or some rural properties, income properties, you know, I've actually had to pay $5,000 for the price on a 16-unit building. Your credit report, most lenders are going to charge between $50 and $75 for this, depending on how many people they're running the credit report for. Tax service. This isn't even in your statements. This is a service that every lender pays for. It's still about $75. It's been $75 forever. This will notify the lender if the buyer or the borrower gets delinquent their taxes. Because again, one of the conditions of making a loan is that keep your taxes in the insurance. So now when they impound, which again, I would say the vast majority of loans are impounded, which means the lenders pay taxes and insurance. But if they ever remove the impound accounts or they don't impound from the get-go, it's good to have, because as soon as they get wind of it, they're going to pay it and bill the borrower for it. Title insurance. So this is for the buyer's lender. Remember, the seller pays for your buyer's owner's policy. The buyer pays for the lender's policy. Now that lender policy is always a loss policy. Every lender I've ever heard of requires an extended coverage policy. Now you can get an exact quote from the title company, but since you're on the buyer side, you probably don't know what kind of coverage that's going to be. I use $1.19 per thousand with a base of 180. That usually gets me within $30. So, and I try to keep my ear to the ground on whether the rates are going up or not, so I can tweak that. Escrow. So remember, with escrows, there is one escrow fee. It is split in two. Okay. Which is why on the contract we write 50-50. Most escrows, some charge more, but most escrows charge $2.50 per thousand of purchase price with a base of $2.50. On our escrow only charges $2 per thousand. And also remember that honor escrow, just like referred beforehand, if we are able to bring a buyer side escrow into honor, they will give, as an incentive to the seller to do so, give them up to 40% discount off of their half of the escrow fee.
So escrow paid by seller and buyer?
Yeah,
Easier.
the 12 feet split 50/50. And then again, if let's say Remax is the listing agent, they agree to use honor. Honor will have 40% off of the seller side.
Can you go back to the income? Can you
Yes.
explain that a little bit?
So impounds is where it's technically called an escrow account, but don't get it confused with this kind of escrow. Remember, escrow is just a third party that's holding it. Part of your payment, part of your monthly mortgage payment is set aside by the lender for taxes and insurance. And then they get a copy of the tax bill and they get a copy of the insurance bill and they pay it like it's due. So, and I recommend it for most people because people are horrible savers. And people that don't impound tend to get over.
So this is paid before, before the close escrow?
So part of it is, and we'll get to that in about 4 or 5 slides. But yeah, they kind of prime the pump. You have to deposit a certain amount in escrow, so they have enough then. And that is very much based on when you close escrow. There's some months that you're gonna prepay 9 months taxes, and then there's some you're only gonna prepay 2. So I have a cheat sheet on my wall because I still don't have that. Sub escrow. Now, again, confusing. This is not an escrow fee. This is actually a title fee. Because title insists on handling the money. So, and they insist on charging for handling the money. And that's all sub escrow is. I mean, this is all they supposedly do, but it's receiving the loan funds, making the payoffs, dispersing any overages, et cetera, and paying taxes.
Can you explain why we need title?
Oh, yeah. So, because California is the fraud capital of the world, for one. Remember from pre-licensing about grantees, okay, and priority. So if I hand you a grantee right now to my house, fully executed and notarized, doesn't have to be that. But for consistency, you don't record it, but you own my property. Now I hand this, another one to Andy, and he records it. Who owns the property?
Andy.
No. No, you still own it. Problem is, now Andy's went and gone and got the loan on the property. Now it's a big old piece of, because you never got title insurance. But you own the property. If you had gotten title insurance would pay them because you own the property, because it covers unreported fees.
So he's still uninsured.
He's still uninsured. I committed fraud, but we're not even talking about that. That's why we get that insurance.
From my understanding, there's one for the lender and one for us,
Yes.
right? For the agent.
Absolutely, well, not for the agent, for the owner. And they cover slightly different things. The lender wants it because they're insuring priority over anything else, a valid, enforceable, foreclosable lien. That's all they can. And that's why they want the best odds. Great question. The first one that's ever asked. Loan tie-in prep fee. This is a garbage fee that escrows use to make extra money. So kill me for saying that, but realistically, that's what it is. Because the same sub escrow fee that title charged you for, or your borrower for handling the money, This is what escrow uses for handling loan documents, which used to be part of what they did anyway. This fee's been around for 25 years, so it's not going up. That's typically about 250. Miscellaneous, there's a lot of little tiny charges that I lump into one: recording, notary, courier, wire fees. Prepaid interest. So this is where we get to your question. Well, one of your questions. Escrow is going to collect prepaid interest from the close of escrow to the first payment due date. Because remember, with a mortgage, you're paying in arrears. With rent, you're paying for it. So you pay rent on June 1st, you're paying from June 1st to June 30th. You pay your mortgage on June 1st, you're paying May. I always calculate 30 days upfront because we never know when it's exactly going to place. Prepaid interest. If you have an impound account, which again, anything that is greater than 80% unconventional requires an impound account. All government loans require an impound account. So the lender's going to collect 2 months to, again, prime the pump, have a little bit of extra money there to make sure they have money to pay the insurance vendor. If on a rare occasion they don't, and that's usually due to a jump in premium or something, they're still going to pay it, but then they're going to add it to the next bill. Prepaid mortgage insurance, the same thing. Homeowners insurance, the first year gets prepaid during escrow. A lot of times, depending on who your insurance are, usually they'll bill escrow, but sometimes if you're dealing with some public insurance, then they're going to require it upfront.
What's the difference between the homeowner insurance and the previous one?
Mortgage insurance,
The prepaid insurance? And then
prepaid insurance is homeowners fire insurance, basically.
Fire?
Fire and hazard. Whereas mortgage insurance is for the loan. So what mortgage insurance does is it covers, let's say you're doing a 90% convention. That mortgage insurance covers the lender in case of default on only the balance above 80%. So if they foreclose, that MI company is cutting a check for that 10% right away. So they're only carrying about 80%. That's nothing. So here's a handy dandy worksheet that I created many months ago. And this is where the rest of the paperwork can be packaged. Fine. We're going to do this exercise. So before we get it into here, and I don't have slides for this, I'm going to teach you how to read a pay stub and read a credit report. Okay. So I believe the first the last piece of paper are pay stubs. These are for 2 of my clients. And you'll see, should be highlighted, year-to-date income, okay, which is all we care about. We don't care about what they make that week. Lenders will to a point because they want to make sure they're working full-time and working consistent hours. But you simply take the year-to-date income, look for the date. Let's see, on the first one, you'll see pay period date through April 30th. Okay, so that makes it easy. That's 4 months worth of income. So their year-to-date regular pay, that's total earnings, that's going to show 6274.93 is how much. Can't remember her English name, and I can't begin to pronounce her Vietnamese there. Made for that job that year. So to calculate income, I'm going to do 6274 divided by 4. That's our monthly gross income. And then on the back side is her husband Quad. This was a little bit different. You have a pay period ending 5/5. So your calculations can be a little bit different, but your gross pay is 63.85 year to date. So you're gonna divide 63.85 by, okay, so what's 5 divided by 30? There's 30 days in a month, it goes 5 days into the pay period. That's 0.16. So you divide that by 4.16. And that's going to get you your monthly gross income. They're co-borrowers, so both of those, that's your monthly gross income for your buyers. Now, with the scenario that I created, it's Sunday, it's 4 o'clock, you're in an open house all by yourself, you have no lender with you, your lender doesn't work on weekends, like most. Somebody walks in, falls in love with the place, I want it. Now what you gonna do? Majority of agents, unfortunately, are gonna say, here's my lender's card, give them a call, get yourself pre-qual and call me back. Then we'll write. Now, for the last 2 years, that property's not gonna be there by the time they do that, if they do, and the odds are they're not going to. Okay, now the property might be there, but the real risk is they're not gonna do it. So who here is stick and bold? Just one. So behind the copier, you'll see a little tiny sheet with bold laws on it. Okay, and these are undeniable truths of life. Quote my favorite radio shows. One of my favorites, and it applies to this, is logic makes you think. Emotions make you act. Think about any big purchase you've made, any sometimes stupid thing you might have done. That's usually emotions causing that. If you got the chance to sit there and think about it, you're probably going to talk yourself out of it. Yeah. I think lots of girlfriends have this very much that they apply to. Now, when you have a buyer wanting to write an offer, they're emotional. Okay. You give them a card and send them home, yeah, they're done. Within an hour, they're done. So don't do it, okay? Your job is to write that offer or figure out a way to. Now, yes, we don't want to waste our time and because they still have to talk to our lenders no matter what. So how do we get them to do that? By making them invest in the process. This is part of the process, okay? If they write an offer and they know you can't present it until they call your lender, I'll bet you whatever I have in my wallet, they're going to call that lender probably within 45 seconds to 60 after they walk out the front door. Okay. They will follow up. So in order to do that, you need to ask them questions. The second question you should ask them after, are you working with an agent? Is, of course, have you seen a lender? Then the third question is, okay, let's talk about your finances and your qualifications. Since we need to get you with a lender, we need to make sure that this is within the realm of possibility. So how much cash do you, Mr. Buyer, have to work with for the purchase of this house? I don't want to ask them how much is their down payment. How much cash? Because again, you got to consider closing costs. Okay. So here we're using FHA because the second question, regardless of how much they say they have, is what is your credit like? So who here knows if they have good, fair, or poor credit? Right? Okay. Much different than it was 10, 15 years ago. So like, yeah, I think it's okay. Full credit, it's like 450. Okay. But now, you know, we have Credit Karma, we have credit scores in our bank statements. Everybody has an idea of what their credit scores are. Newsflash, they don't, but they have an idea. Okay, I can tell you right now, my Experian app says my credit score is about 670. Okay. Just bought a house that was higher than. In fact, my Experian was my low score, but remember,
Was it by a big difference or?
by about 50. Now, it's gonna fluctuate all the time, depending on when whatever's reports. You have different accounts that all report on different cycles. So your FICO score could change day to day. But it will get you in the area. If they're telling me 670, I know they're not 550. Okay, 670, I know they're FHA. I know they're probably gonna have a hard time going conventional, depending on how much cash they have. Even though conventional is a 620 minimum. So these people didn't have a lot of cash. They had about 50 grand. Okay, so, and they told me they had a reasonable amount of debt. So, which is my next question, okay? Well, next question is income. How much do you make? Now, nobody I know is walking around with the tax returns in the pocket. Some might have a pay stub, but very few will. But you know what you make, okay? Few of you here I know have other jobs. You know how much you make an hour, right? So even if you don't know what your monthly gross is, yeah, okay, you make 20 bucks an hour, you work 40 hours a week, yeah, easy math to do. So that's what we use. Happen to have those pay stubs, so show you how to do that. But and remember, we're taking their word for it for this calculation. Okay, the real numbers are always going to be a little different. Okay, but that's what my lender to figure out. So based on the fact that now with their income, we know they have debt, we know they don't have a lot of cash in Disney FHA all day long. So 3.5% of 469, yes, this was about 5 years ago. Their down payment is 16,450. So based on that calculation, and we know it's FHA, what is their loan amount?
Or 453,588.
No, but I know why you said it. And now everybody's looking at it. Okay,
It's not,
this is. How about 460,505? Do we know why? Remember FHA, you have upfront mortgage insurance premium of 1.75% that gets added on to the loan. This is the single biggest mistake agents make on their net sheets because they do it for the wrong loan amount. My lender yelled at me constantly for doing that. Up until a couple of years ago when I changed my net sheet. Because again, your monthly payment goes off of this. So interest rate. Now, I talked to my lender first thing in the morning and last thing at night, and usually 2 or 3 times in between. So I know where interest rates are every day. As agents, it's our responsibility to have a good idea. Okay. We had a reasonably good idea from talking to John earlier. Now, again, this is 5 years old, so it was 3.5. So our monthly payment will be $29.63. And I did chop off the cents. So now, take a look at your credit report, which is page 3 of your pack. You may never see one of these up front, but it's interesting to look at. This is your typical TriStar. This is a combined report. Now you'll see on the second page, it's gonna have each of their FICOs. Okay, and who it belongs to. Ignore the reasons below because they're really immaterial. Okay, but you have 709, 726, and 708 for one, so you use the mid score of 709. 781, 767, and on the next page, 746 for the other one, and you would use 746. However, for loan purposes, it's going to be 709 because they're always going to use the lowest of the two. So they have FICO scores that can go to much, but cash and debt is going to be a different story. So if we look on page 3, so you're going to see under the ECOA column, this is going to tell you whose it belongs to. B for borrower, C for co-borrower, J for joint. And it's going to show you their payment history, which is great, but really all we need to know is if you look to the right where it says 30, 60, 90 plus, as long as those are zeros, that's good. That's no delinquency. It's going to show their high credit, or the first one's a Toyota Motor Credit auto loan. That's how much their original loan amount was. Shows what kind of loan it is. It's an auto loan. Their current balance as of the date reported was 25. We really don't care about that because it's an installment loan. Their installment payments are 441 a month. So we're going to use that. Sally Mae. Sally Mae is a student loan. Student loans, how underwriters look at student loans changes as the loans. If there's a payment showing, and in this case there is $53, they'll use that payment. If there's no payment showing, regardless of whether it's in deferment or not, they use 1% of the balance. This is the only buyer I've ever had that actually pays their student loans. Student loan below that. Another Toyota, and yes, they had two cars and 2 auto loans. More student loans. More student loans. She had a crap ton of student loans. But she was current on every one of them. Okay, so now you get down to Chase card. Revolving debt, that's what a credit card is. So again, similar to student loans, we're going to show a $12,000 limit. Says REV for revolving. Their balance is only $1,680, and their minimum monthly payment is $30. Now, and the reason why I showed you this is when we're sitting across the table from the buyer, obviously we don't have this. The question we ask is, hey, do you have any auto loans? What are your monthly payments? Do you have any other installment loans like personal loans or student loans? What's your payment? And again, for student loans, oh, they're in deferment. Okay, what's your balance? And take 1%. Do you have any credit card debt? Yes. How much monthly payment? I pay $100. Okay, great. How much is your minimum monthly payment required? Because that's what we use for debt ratio. If they don't know, and they may not, what's your balance? Take 2.5% of the balance, and that's what you need. That's one number. So, based on what's in there, we have 1,088 in installment loans. That's what your car payment is. A whopping $143 in credit card debt. $314 in student loans. Other is going to be like child support, alimony, separate payments, stuff like that. Because that's another question. If you get somebody whose credit might be so-so, okay. You need to ask them, you know, have you ever had anything foreclosed on, repoed, or bankruptcy? Again, last 4 years is what we're looking at. If they had something foreclosed on the last 4 years, sorry, they can't have house. Hard money, they could do, that'd be a bad And they'd be hard pressed to do that. So again, we use the 709 credit score. And then we ask them, how long have they been on their job? How long they've lived, where they live. Okay. Now, again, even if they just moved, which happens for them, yeah, are they in the same area? Are they staying in Orange County, or did they just move here from New York? Yeah. Residency is probably the least important requirement and most often overlooked. But employment, very important. Say you have somebody that's only been working a year. They're gonna have a hard time getting one. Or maybe they've been unemployed for 3 years. Okay. Right now, it's actually somewhat easy because we just blame COVID for it. Whether it was COVID or not, we blame COVID for it. Okay. But typically, underwriter wants to see you back at work for as long as you were off. So, big question, are you self-employed? If that question is a yes, stop, send them to your underwriter. Because as most of us will know, we will deduct everything we possibly can and half a dozen things we probably should. Okay, right. Yeah. I mean, I made 260K last year and like I said, I can't figure out how I. So depending on what they show is what we can use. Bottom line. And you don't, tax return analysis is an art form. Okay. I've taught it. I've done it. Some of those things get ugly. Yeah. Most of y'all would not be able to figure out how tax returns at all. You know, because I'm an escort, I take payroll, and, you know, and I think you do too, right? Yeah, exactly. So I was looking through a tax, I had to help mark my tax returns. That's how complex they are. And my mother's been doing this for 40 years. So, yeah, agents should not be reading tax returns. Okay, that's one thing I would say that we should not be doing. Leave that to the experts. But ask the question, you know, how much are you showing income? Yeah, they very well might know that, or at least close. Okay, and if it's enough, then go ahead with the offer. But in this scenario, source of down is savings. Now remember, if they're short cash, many loan programs allow all or part of your down payment and closing costs you get from somebody else. So based on this number and the gross income figure we were talking about, I get a 32.9% front end ratio. Okay, that's dividing the 1545 divided by what we use for gross income. Add this payment 2963 to that. And now we get 50.8. And this is the other thing that takes us out of convention. So there's no other way to do this short of hard money other than FHA, unless the guys are dead. So again, if we're over these, don't proceed with FHA. Because we can't. It can go either way. So, but in this case, everything matches. So what do? We write it out. Oh. When you write the offer, make sure you tell them, don't buy fruit. I can't tell you how often this happens. Don't buy furniture during escrow. I have had buyers buy $15,000 worth of new furniture. And then they put it on a credit card and they don't qualify anymore. and they can't return the furniture, and now they can't buy the house. That particular one I found out about a week before. So I tell them, I said, I don't even want you, take your wife to dinner once we open escrow, and then don't spend another penny. Okay, just be safe. But that's the basic exercise, you know. We can do that more than just at an open house. We're door knocking for buyers, okay? Did this for years. You know, buyers, remember I've told you this before, one of the biggest reasons renters rent is they don't know they can buy. So having that form to fill out and say, hey, you can, you know, and it's something different about just saying you can and showing them that you can. It's a big deal. It's much more effective. So that's how we get deals in investment. That plus having a kick-ass lender. Yeah, which I've been very fortunate to do. You know, remember, your lender is your most crucial relationship. Okay. Escrows are great. Okay, but as buyer's agents, we usually don't get to pick those. Yeah, most escrows suck. But lenders are a dime a dozen. Good lenders are rare. Yeah. You know, that's why I stick to mine like glue. And I'm 65, been doing this for 40 years. I told you, you got to do this for at least 20, because I got at least 20 left in there. So I'll be down if I'm doing another manage. But yeah, that's very important. Someone that, again, is looking for ways to do the deal. You know, I prefer mortgage brokers over direct lenders, because direct lenders are pricier and they're kind of handcuffed as to what they can do. They don't have one source. Okay, typically, mortgage brokers, like that guy, will deal with 100 different sources, even though he's only going to use the same 2 or 3 over and over again. If something is way different, the options are there, you know, and they're flexible, and you know, and they can be flexible to do a deal for bare bones, you know, if necessary. You know, knowing, hey, they'll be more comfortable. So again, having that relationship crucial. Any questions on anything? We went very fast. I threw a lot of information at you. Yes.
So for the 2-year employment, they don't necessarily have to say that they just have to have a reason why they were jumping.
If they're changing job fields, yes. If they're in the same field, they can have 10 employers. Yeah. But if, let's say they went from working at a motel to a chemical engineer, yeah, you gotta show why. It's almost always pretty logical when, you know, if somebody's astute enough to buy a house, yeah, they're probably not job hopping. Yeah, they're probably pretty stable to begin with. It's just documented. Lenders want to document everything. Down payment, you know, cash under the mattress not accepted. Okay, gotta have bank statements showing a 60-day trail of that you've had control of that money. Okay, if it's a gift, same thing. You get a gift letter from mommy and daddy and a couple of their banks. Okay, it's also an anti-money laundering. So, but yeah, as long as it's documented, we can do just about it.
Talk about the people who they used to
Hmm?
So if they said they wanted to buy, how would you buy? Like, how long do they need to stick the money in the bank?
Great question, because I get a lot of this. Tends to be a cultural thing. Okay, with me, I most of my buyers at one point in time were not English speaking extent, and especially in the 90s and early 2000s, I would say half of them were keeping money in a coffee can. I tell them simply put, 60 days prior to close of escrow, that money needs to be in the bank. So they're not going to question where it came from as long as you got control of it for 60 days. As I tried to picture the cash on the mattress, and I said no. Because I've had it a lot. You know, another way to get around it. Maybe they have a friend or family member that actually has that amount of money in the bank. They can do a gift letter, okay, the money has to come from that account, but then they can just give them the cash. That's what they do. It's a great way around it. I use that one more often than not. Because, you know, you can put the money in the bank today, especially in the last 2 years, it might be 6 months before you close escrow. We actually get a deal because you know, I was writing 25 offers per buyer. That was ridiculous. You know, now it's going to be a lot easier, especially after today. You know, we're still seeing multiple offers on everything, but we're not seeing 40. We're seeing 3 or 4. And multiple offers might be going away pretty soon with this last jump. So it's getting a little rough out there. But the good news is, buyers we're getting today, this is what they know. Buyers we had up till January, February, they're pissed. You know, there's like that. I'm done. Okay. Without realizing they're screwing themselves. But they've got their mindset of 2.5%, 3% interest rate. Now it's 7%. And then Johnny wasn't willing to prophesy, but I say by the time this is done, we're at 9. No, we've never seen this before, but we have. We've got to go back to the late 70s to see this. Okay, we do. At the risk of getting political on you, we do have the second coming with Jimmy Carter. And look at what Jimmy Carter did to inflation and interest rates in 1977 through 1980. The exact same. Oil prices, high interest rates, high prices on everything. Okay. Y'all weren't around when I was. 21%. My mom was doing deals when I was in high school. My mom was doing deals at 20 and 21% with Mark. First deal she did with Mark was 21%. First deal I did as a licensed agent in 1988, 12.5, and we were so excited. Just got down to under 15. Okay. Everything's relative. Okay. You guys came in at the lowest interest rates we've ever seen. And a booming market. And you're not alone. I mean, it's easy to think, hey, this is how it always is. No, and I never want to see it again. Okay. I worked harder for 2 years than I ever have in my life. Okay. I like normal, but this is also where the skill and the cream rises. You're in the right place because you're here obtaining that skill. I guarantee you there's hundreds of agents out there that aren't, and they're talking out the facts, really. Okay. I talked to a pair of them the weekend. Okay, it's amazing what agents don't know and what they're not getting in other places. So you can never learn too much. Okay. I still learn. Okay. I learn all the time. I still take classes, believe it or not. You can always learn, but the foundational skills that you're building today are going to help you the rest of your life. So thank you so much for being here. You know, as a market center, that means a lot to us because we want to help you grow. And you're all in the mentorship program. So same coming from me. My job is to help you. So you know, we don't do this without you. So at that point, I'm going to kill the Zoom. Oh, wait, I think I got a question on Zoom. I'm really bad about that. Sorry, Zoom. Oh. Hello. All right. Excellent. Well, thank you, everybody. I'm going to go ahead and shut down now. If you have any questions, you know where to reach.